Hey everyone, and welcome to today's Explainer, the rotation playbook and the rising financial leadership case. If you've been actively managing your portfolio lately, you've probably seen some tremendous gains in clear leaders, places like defense and telecom. But as your advisor, my job isn't just to look at what worked yesterday, it's to position your capital for tomorrow. So let's look at the shifting market dynamics that are presenting a massive new opportunity for ETF investors right now.
Okay, let's dive into this. One of the biggest illusions out there, especially among retail investors, is this idea that market leadership is a constant. It's easy to think that a sector that goes up is just going to keep going up in a straight line forever, right? But the reality of capital markets is actually far different. Instead of just chasing the hottest trend from last week, the absolute most critical question we need to ask ourselves right now is this: where is institutional money likely to go next?
To answer that, we really have to understand sector rotation. This is the natural cycle where institutional capital, the smart money, moves away from extended, crowded sectors and quietly builds new positions in areas that are consolidating. See, institutions operate in phases. First, they accumulate. Then, the sector starts outperforming. Eventually, everyone else notices. The trade gets super crowded and the sector just needs to consolidate. While retail investors are busy buying at the absolute top, institutions are already looking for the next big opportunity. Our goal today is to manage your risk by recognizing this cycle and to spot that next wave of leadership before it becomes obvious to the rest of the world. Let's start with our recent heavy hitters. Take a look at the Capital Markets Index on the left and the IPO Index on the right. Both feature this purple line at the bottom. That's our relative strength indicator, which basically maps the sector's performance against the broader market. Now, just a few weeks ago, these lines were surging. Institutional participation was incredibly obvious. But notice the right edge of both charts now. Price is pulling back. Momentum is slowing down. The relative strength is still elevated, sure, but it's no longer accelerating. I really want to reassure you, this isn't weakness. This is just healthy digestion. The easy money from the initial run has already been made, and these sectors have simply earned the right to take a well-deserved pause.
Let's move on and see how this builds when we look at defense and telecom. They followed really similar paths, delivering massive rallies and getting significantly extended above their moving averages. Defense surged by over 60% over the last several months compared to the broader market. But notice the sideways movement now. The momentum has cooled off. The purple relative strength lines are still high, but they've totally flattened out. And honestly, this is exactly what leadership sectors do after a major advance. They consolidate to let their moving averages catch up. They definitely remain leaders, but from a risk management perspective, they just aren't an early-stage opportunity for new capital right now.
We're seeing the exact same breather happening in healthcare and chemicals. Healthcare has quietly been a fantastic performer, and chemicals recently showed a very sharp recovery, reclaiming some key moving averages. But after those strong advances, both have entered a consolidation phase. Again, reframing this is absolutely crucial for managing your portfolio. Institutions aren't abandoning these sectors, but they are absolutely not chasing them aggressively at these current elevated levels.
To really hammer home how widespread this phase is, check out the EV index. It perfectly reflects this broader market digestion. We're seeing totally normal price behavior after a strong run. The main takeaway here is that, across the board, the most hyped sectors are basically taking a seat. The initial sprint is over, and we're now settling into the marathon phase. Now, while those extended sectors rest up, some sectors are maintaining incredible structural integrity. Power and utilities are experiencing what we'd call healthy, controlled pullbacks. The larger trend here remains completely intact. Notice the relative strength on the bottom. It's still significantly higher than it was, say, 6 to 9 months ago. This tells us that even during a market-wide pause, institutional interest in power and utilities remains highly resilient.
And capital goods? Well, that might just be the gold standard chart for institutions right now. Notice how beautifully the price stays supported above the 50-day and 100-day moving averages. The corrections here are remarkably shallow, and the relative strength is just rock solid. The macro capex story is clearly alive and well, and the market continues to reward it. If you want to know what a structurally intact, high-quality trend looks like, this is literally it.
However, not everything is consolidating healthily. Let's contrast those strong trends with CPSC and metals. The relative strength line isn't just flattening here, it's actively rolling over and trending lower. Price remains under pressure, and these sectors are clearly showing real signs of fatigue. From a wealth management perspective, these currently lack the quality setup we want to target. They basically lost their leadership status for the time being.
So the crucial point is this: leadership transitions often begin with improving relative strength before they become obvious in price. This is really the climax of our briefing today. Identifying the early signals of institutional accumulation is exactly how you generate superior returns while managing your downside risk. We want to find the sector where that purple line is turning up, but the price hasn't exploded yet.
And that brings us to the core thesis of today's explainer. While retail investors were out there chasing tech and defense, institutions have been quietly accumulating banks. For months, the Nifty Bank Index underperformed. It was lagging behind the 20% gains of the broader market, and it was largely ignored. But notice the right edge of this chart. Price is reclaiming key moving averages, it's challenging resistance, and most importantly, that purple relative strength line is sharply rising. Because banks aren't significantly extended above their moving averages yet, this offers an absolutely excellent risk-reward profile for your portfolio.
And this brilliantly illustrates the broader shift. We aren't just seeing a random anomaly in one index. We're seeing simultaneous improvement in momentum across the entire financial ecosystem, all the way from private banks to financial services. Private banks spent a long time underperforming, expectations got incredibly low, and the weak hands were completely shaken out. But now, price, momentum, and relative strength are all improving at the exact same time. When the broader financial sector confirms a breakout together like this, it signals a massive institutional capital rotation. We are witnessing the very early stages of a brand new trend.
So how do we actually translate this into a wealth management strategy? Well, here are 3 actionable steps for rebalancing your portfolio right now. Step 1. Acknowledge the rotation cycle. Understand that market leadership changes, and trying to squeeze the very last drop out of yesterday's winner is a seriously risky game. Step 2. Allow your extended leaders, like defense and telecom, to consolidate. Don't aggressively add new capital to extended charts. And Step 3. Target improving relative strength. Shift your focus and your capital to areas where institutions are building new positions with favorable risk-reward setups. And right now, the data strongly points to the banking sector.
The old leaders are resting, the structural leaders are holding strong, but the financial sector is really stepping up to the plate. This is the exact setup we'll be watching incredibly closely in the weeks ahead to help protect and grow your capital. So I'll leave you with this final thought to ponder as you review your own portfolio. Based on the rotation we've explored today, which sector ETF do you believe will truly be the next market leader? Think about it, and let's make sure you're positioned for it. Thanks so much for joining me on this explainer, and happy investing.